Welcome to the deep dive. Okay, so today our mission is tackling this really comprehensive 2024 shareholder letter from, well, one of the most successful compounders out there.
Right.
We want to extract the absolute essence for you. Think of it as a shortcut, basically, to understanding their performance, their core philosophy, which is pretty unique, and, where they're headed next.
Exactly. And for you, the learner, this isn't just about um, looking at last year's numbers. It's really about getting the blueprint for how a company achieves this kind of sustainable, decades-long growth.
Yeah.
We need to zero in on how they pulled off an 18.7% compound rate on book value. I mean, that's over 39 years.
Incredible.
And crucially, why the leadership sees their culture, particularly that decentralized structure, as their main competitive advantage, their moat, as they call it.
Okay, let's hit the scoreboard first, because even for these guys, 2024 was pretty exceptional.
It really was.
The stock surged, right? Jumped 64% over the year, and it finally broke through that CDN $2,000 level.
Yeah, big milestone.
But the really mind-blowing number is for the long-term folks. If you got in back in 1985 at CDN $3.25, you're looking at a 600x gain. Just historic.
Yeah. And when you see numbers like that, you immediately ask, okay, was it just luck, good market timing, or was it, actual operational strength?
Right.
And the letter makes it pretty clear. They posted record consolidated underwriting profits, $1.8 billion. That shows the core insurance engine is firing on all cylinders. And this is key. Record interest and dividend income, $2.5 billion. That confirms the investment strategy they set up during those lean, low-rate years. It's paying off big time now.
Yeah, that patience factor. Which brings us nicely to their core philosophy.
All right.
This company, they're not thinking quarter to quarter. The letter talks about a 100-year plan.
100 years.
And front and center, they state very emphatically that they will never abandon their decentralized operating philosophy. Why so strong on that point?
Well, I think it's because leadership is changing hands. The next generation is stepping up. And they're basically using this letter to carve their culture in stone almost, to say this is the non-negotiable asset.
Okay.
It's built on this idea, this faith, really, in the many of the local leaders rather than just a few folks back at HQ. And culturally, you see it in simple things, like they prominently display the golden rule everywhere, and they constantly remind their CEOs of that Ronald Reagan quote. The
Well,
one.
hope without credit.
Yeah, exactly. There is no limit to what a man can do or where he can go if he doesn't care who gets the credit. It's all about tamping down the ego to empower people.
Okay, empowerment sounds great. But structurally, doesn't that risk, chaos? How do you keep quality control, brand consistency across dozens of separate companies if everyone's running their own thing? Isn't that a weakness sometimes?
That's the million-dollar question, right? And the letter tackles it head on. They lay out the specific advantages that, look, if you manage it right, with the right people, they believe these advantages outweigh the risks. We picked out 5 key ones.
All right, let's walk through them. First up, ownership and accountability.
This is fundamental. Each CEO of an operating company, full autonomy. Underwriting, operations, it's all theirs. The only thing HQ keeps central is capital allocation and the overall investment management.
So the buck really stops with them.
Absolutely. No hiding behind some committee decision from head office.
Yeah.
Your results are your results.
Which must feed into the second point. Management retention. If you trust people, they stick around.
Exactly. The letter makes a point of saying their presidents, their senior execs, they average close to 20 years with the company.
20 years average. That's unusual today.
It's a massive advantage. Think about it. Most companies, management turns over every few years, right? Constant strategic U-turns. These guys, they stay. They build deep institutional knowledge. Their competitors just can't match that kind of consistency.
Okay, third benefit. Flexibility and nimbleness. They gave an example of how this helps them, particularly in tough markets.
Yeah, a really good one. They pointed to the hard market between 2020 and 2023. Remember when the cyber insurance market just completely flipped in 2020?
Oh, yeah. Chaos.
Total chaos. But instead of some top-down mandate, 4 of their big companies actually pursued 4 different strategies to handle it.
Interesting. So they let them experiment.
Kinda, yeah.
Yeah.
They let them test different approaches simultaneously, expand in different ways. A centralized company. They'd probably still be debating the single right strategy, Way too slow, they would miss the boat.
All right, fourth advantage. This one's about acquisitions. Reduced leakage. Mergers often go badly. Lots of people leave.
The classic pitfall, huge value destruction often happens.
Yeah.
But this company, They rarely integrate acquisitions. They buy a company, and usually they let the existing team keep running it, just, with their capital and oversight.
So they keep the talent and the business intact.
Much more of it, yeah. They avoid that typical post-deal implosion.
And the fifth one, financial flexibility. Having separate companies gives HQ options.
Big options. We saw this a few years back. They actually sold off a small, like a 10% stake in one of their subsidiaries, Odyssey.
Okay. Why?
Specifically to raise cash to fund a big share buyback at the main holding company level. That kind of surgical move, using a piece of a subsidiary without disrupting its operations, that's only possible because of the decentralized structure.
Okay, so that's the structure, the how, but what makes it actually work? The management team talks about the 3 T's.
Right. These are like the essential ingredients, the intangibles. First, you need reciprocal trust between HQ and the operating CEOs and vice versa.
Makes sense.
Second, transparency. Open communication constantly, no surprises. And third, you absolutely need the talent. You need really good people running these businesses. They see these 3, trust, transparency, talent, as the real cultural moat. It's hard to build and impossible to just, quantify on a spreadsheet.
Okay, if culture's the moat, let's talk about the engine room, the actual business. Property and casualty insurance, reinsurance. That's the core, right? 68% of their premiums in North America. And it's growing fast.
It really is. And mostly organic growth, which is impressive. Gross premiums written are up 136% just since 2017.
Wow.
And that massive growth on the top line, it flowed right down to the bottom line in 2024. Record consolidated underwriting profit, $1.8 billion, like we said.
And the key metric confirms that profitability, the combined ratio.
Spot on. Consolidated combined ratio was 93%. Just to remind everyone, that ratio is losses plus expenses divided by premiums. Below 100% means you're making money before you even invest the premiums.
And 93% is pretty darn good in insurance.
It's excellent. Really disciplined. And a couple of their companies, Allied World and Northbridge, they actually tied for the best ratio, both hitting 89%. Just stellar performance.
Now, keeping that engine running smoothly means thinking about succession. And the letter highlights a key transition, which really exemplifies that decentralized approach.
It does. Brian Young, who was CEO of Odyssey Group for a long time, he retired. But get this, he left after delivering 13 straight years of underwriting profits and reserve redundancies.
Okay, pause there. Reserve redundancies, that means they consistently put aside more money than needed for future claims.
Exactly. It's ultra-conservative. Building up cushion. That's serious discipline over more than a decade.
So who steps into those huge shoes? A guy delivering record profit, $505 million in his last year.
Carl Overy. And here's the key. He'd already been with Odyssey for over 20 years.
Ah, promoting from within.
Almost always. That's the pattern. Deep bench strength. Davidson Padiz moving up to CEO at Zenith, Bob Sampson at Riverstone. They grow their own leaders, so they rarely need to look outside. Succession is smooth.
Okay, so this incredibly profitable insurance machine, it throws off something even more valuable, right? Float. Can you just quickly explain float again?
Sure. Float is basically the money insurance companies hold temporarily. It's the premiums they receive up front, which they get to invest before they have to pay out claims down the road.
And how big is this investment pool for them now?
It's massive.
Right.
$36.9 billion. But here's the really clever part, the financial alchemy, almost. The cost of float in 2024, it wasn't cost at all. It was a 5.2% benefit.
Wait, a benefit? Float is usually seen as a liability, right? Money you owe eventually.
Yeah.
How is it a benefit?
Because of that underwriting discipline we just talked about, their combined ratio is consistently below 100%. Their long-term aim is actually no-cost float, but they're doing even better than that.
So they're essentially getting paid to hold the money.
Pretty much. They're earning 5.2% on that $36.9 billion just from the insurance operation itself before they even invest it. They've turned what's normally a cost center, or at best zero-cost funding, into a profit center. That's free cash flow to invest. Genius.
Okay, so underwriting provides the fuel, the float. The investment side is the accelerator. Let's dig into that fixed income strategy. How did they manage that big jump in yield to 5.2% when a rising rates caught so many others off guard?
It really boils down to patience. Agonizing patience, probably. During those super low rate years, say 2019 to 2022, they just refused to reach for yield.
Meaning they didn't buy long-term bonds just to get a slightly higher return.
Exactly. Lots of institutions felt forced to do that, these guys. They kept over half their fixed income portfolio in cash or very short-term treasuries. They accepted lower returns for years.
That must have taken some nerve, watching others seemingly earn more.
For sure. But then, when rates shot up quickly, They were sitting on a pile of cash, ready to deploy at much, much higher yields.
Ah, so they timed it perfectly, or rather their patience paid off.
Precisely. The result, the yield on their fixed income book jumps from a low of maybe 1.5% in 2021 up to 5.2% in 2024. And that single strategic decision boosted their interest and dividend income by 32% last year alone, hit $2.5 billion. Huge impact.
Okay, but despite nailing that bond move, the letter sounds, well, pretty cautious about the U.S. stock market right now, explicitly cautious. What are the warning signs they're pointing to?
They lay out some pretty stark numbers. They note that the U.S. market cap is now over 70% of the entire MSCI World Index value.
70%. Has that happened before?
Only once, really, right before the dot-com bubble burst back in, like 1998-99. That's the comparison they're drawing. And they didn't just leave it there. They named names on valuations.
Yeah, they weren't subtle about it.
Not at all. They called out NVIDIA at 43 times earnings, Tesla at a whopping 133 times earnings. And even, solid defensive stocks like Costco trading at 62 times earnings. Their point is, the froth isn't just in tech, it seems widespread.
And they linked this market valuation concern to bigger economic issues, like the U.S. budget deficit.
Yeah, they mentioned the $2.1 trillion deficit, but maybe more pointedly, the cost of servicing the national debt.
How much is that now?
$1.2 trillion a year in interest payments alone, which, they noted, is basically the same amount as the entire U.S. defense budget now. Their message seems to be, these kinds of fiscal numbers aren't sustainable long-term and might force some kind of reckoning, or at least a different approach for investors. Extreme caution needed.
So, okay, if they're so wary of the U.S. market, where are they putting money? India seemed like a major focus.
Definitely a bright spot for them. They talked about India's GDP doubling recently to $3.5 trillion. The fact that it's produced, 118 unicorns now?
Yeah.
It's just a very dynamic, growing economy. And they have tangible success there, like the IPO of Digit Insurance, which they backed. That company now has a $3 billion market cap. So they're finding growth internationally to offset U.S. concerns.
And they're still doing deals in more traditional sectors, too. Sounds like value investing 101.
Absolutely. Buying good businesses when they're maybe not the flavor of the month. They bought Sleep Country Canada's biggest mattress retailer for $881 million. They felt that was a good price, about 14 times free cash flow. And they mentioned other holdings, like Poseidon and Eurobank, trading at really low multiples, like 7 times and 6 times earnings. So the strategy seems clear. Patience, value, look internationally, look at traditional industries where valuations aren't quite so stretched.
Okay, so stepping back from all the details, if you had to boil down their long-term success to just a couple of key drivers, what would they be?
It really feels like this perfect symbiotic relationship between two things. First, that super disciplined, conservative underwriting engine, the one that generates all that low-cost or even negative cost float.
Right, the cash machine.
Exactly. And second, the investment philosophy, rooted in patience, long-term value, like we saw with that bond strategy. When those two pillars work together in harmony, well, their stated goal of compounding book value at 15% a year, it actually seems quite achievable. They reinforce each other.
And none of it works without the right culture, right?
Yeah.
Getting back to that, there's a great line in the letter about ownership. No one washes a rental car.
Yeah, I love that line. It perfectly captures their emphasis on ownership. They want employees to think like owners because, well, many of them are owners.
How do they encourage that?
They encourage all employees to own shares. And for senior execs, half their bonus is paid in stock that doesn't vest for 5 years. That forces a long-term perspective. It aligns everyone to make decisions for the long haul, not just the next quarter.
And that long-term focus leads to that incredible 39-year track record.
It does. They pointed out they rank eighth among all the companies on U.S. exchanges that have survived and thrived over that period, meaning achieving over 15% annual compound growth. Only about 1% of companies manage that. It's incredibly rare, and it's built on that foundation of ownership and patience.
Which brings us to our final provocative thought for you, the listener. It's easy after hearing all this, especially the warnings about the U.S. market and the debt, it's easy to focus just on the investment takeaways, where not to put your money, perhaps.
Right. But maybe the deeper lesson here is structural. It's about how you build something to last. This company is explicitly trying to build for 100 years, like the chairman says. So in a world that's constantly screaming for short-term results, the kind of results needed to justify those crazy valuations we talked about, we want you to think about the real value of the things you can't easily measure.
Like culture,
succession plan.
Exactly. Is your own business or even your own portfolio strategy investing enough in things like internal succession? Are you willing sometimes to maybe sacrifice a little bit of short-term gain to protect a core value like their decentralized model because you believe it provides resilience for the really long run? That kind of commitment, that might just be the ultimate non-quantifiable asset.